Hi there. Central banks stand at the center of a rapid transformation of the financial sector and the payment system. Innovations such as cryptocurrencies, stable coins, and the walled garden ecosystems of big techs all tend to work against the public good element that underpins the payment system. CBDCs represent a unique opportunity to design a technologically advanced representation of central bank money, one that offers the unique features of finality, liquidity, and integrity. Such currencies could form the backbone of a highly efficient new digital payment system by enabling broad access and providing strong data governance and privacy standards based on digital ID. This is a quote from the Bank for International Settlements. As I indicated in part 3 of the series on money, central bank digital currencies, I intend focusing our discussions mainly on digital currencies. I will include a link to part 3 up here. Today, therefore, is the next iteration about central bank digital currency. Some of the issues I have discussed before, but bear repeating for a full discussion. Before I continue, however, do visit our website where I curate news and publications from international financial organizations and world central banks. Topics cover a wide range of financial and economic issues that affect individual countries or the world economy. For instance, COVID-19, inflation, or the war in Ukraine. Please also subscribe to this channel and be informed whenever we publish a new video. For the past few years, central banks around the world, including the International Monetary Fund and the Bank for International Settlements, have been mulling the introduction of central bank digital currencies, or at the very least are researching the issue. So what is a CBDC? As I previously indicated, a CBDC is essentially a digital counterpart to the national currency, and as such, and as the name suggests, is to be issued by the central bank. According to Badier and Kumhoff, in a paper titled The Macroeconomics of Central Bank Issued Digital Currencies, presented at a workshop of central bank chief economists, which took place at the Bank of England, a CBDC would satisfy the following requirements, and I quote, access to the central bank's balance sheet, universal, banks, firms, households, electronic, for resiliency, probably DLT, national currency denominated, one-to-one exchange rate, coexisting with the present banking system, end quote. DLT stands for Distributed Ledger Technology. Michael D. Bordo, in a paper titled Central Bank Digital Currency in Historical Perspective, Another Crossroad in Monetary History, puts it this way. A CBDC would also, and I quote, satisfy the three basic functions of money by providing an efficient medium of exchange, instant clearing and settlement on the central bank's platform would involve negligible cost per transaction, a secure store of value. An interest-bearing CBDC with essentially the same rate of return as other short-term risk-free assets which provide minimal opportunity cost, a stable unit of account. A CBDC would facilitate the planning of economic actors, end quote. What is the case for a CBDC? Fundamentally, several reasons have been advanced for why a central bank may want to issue a CBDC. Not all lists are the same, so I have sought to include most of them here, not in any order. 1. Increase financial inclusion. According to Bodo in the paper cited earlier, a CBDC may, and I quote, provide access to the financial system for disadvantaged groups who do not have bank accounts. In less developed and emerging countries, this is a crucial reason for creating a CBDC, end quote. 2. Diversity of payment options. 3. New functionality. 4. Facilitating e-commerce. 5. Safety and anchoring role of central bank. 6. Level of trust. 7. According to the Digital Currency Institute of the People's Bank of China, and I quote, to provide a backup or redundancy for the retail payment system, to improve the efficiency of the central bank system with wider access and stronger capacity, end quote. And finally, in a paper titled A Framework for Analyzing Monetary Policy in an Economy with E-Money, presented at the workshop mentioned before, Yu and Henry of the Bank of Canada say this, and I quote, one motivation is to maintain sovereignty, ability to conduct monetary policy, concern that monetary sovereignty can be undermined by declining cash use, increasing adoption of private e-money, digital currency, end quote. On the other hand, because a CBDC essentially means firms and households will hold accounts directly at the central bank, Fed Governor Christopher Waller, in a speech titled CBDC, A Solution in Search of a Problem, said, and I quote, the competition of a CBDC could disintermediate commercial banks, and as cybersecurity concerns mount, a CBDC could become a new target for those threats, end quote. For more on the point of disintermediation, I will include a link up here to part 1 of the series on financial intermediation that discusses the economics of banking. While not everyone is convinced that a case for a CBDC has been made, there are others who argue that in fact a central bank not only has the right, but it also has an obligation to issue a digital currency, with the question simply being one of architecture. One such person is Corinne Zellweger-Gutnecht. In a paper titled The Right and Duty of Central Banks to Issue Retail Digital Currency, published in a collection of papers on CBDC, says this, and I quote, the use of cash for payment purposes is declining at an accelerating pace for various reasons. By virtue of their mandates, central banks are therefore already not only entitled, but also obliged de lege lata under current law to prepare and put in place the issuance of a digital equivalent and complement to cash, a retail central bank digital currency, RCBDC, as soon as possible. By contrast, changes in the law are unavoidable wherever digital cash is to be equipped with properties and functionalities that tangible cash lacks, end quote. For its part, the International Monetary Fund has presented a skeptical legal position. Based on its own research, the IMF has argued that most central banks do not have legal cover to design and issue CBDCs, and less so retail CBDCs. See figure 1 and 2, which are courtesy of the IMF. So what would be the operating model for a CBDC? 3 main options have been identified. 1, a retail CBDC. 2, a wholesale CBDC. And 3, a hybrid. See figure 3, which is courtesy of our Connelly and Frost, in their paper Central Bank Digital Currencies, Taking Stock of Architectures and Technologies. The BIS, in cooperation with the Swiss National Bank, has conducted 2 successful proof-of-concept trials on different CBDC architectures in Switzerland. See Figure 4, courtesy of the BIS 2021 Annual Report. What are the implications for the international monetary system? Indications are that CBDCs come with a clear benefit for international transactions and some risks. According to the IMF, an obvious benefit is that, and I quote, CBDC can be leveraged to improve cross-border payments, which are currently often slow, costly, and opaque, and are not easily accessible. Cross-border payments largely rely on multi-layered correspondent banking relationships, which create long payment chains. See Figure 5. End quote. According to Project Dunbar, which is an initiative of the BIS Innovation Hub Singapore Center, which successfully explored cross-border payments using multiple CBDCs. And I quote, on a multi-CBDC common platform, each participating central bank issues its own CBDC in its own domestic currency. Participating commercial banks are then able to hold these CBDCs directly, gaining access to foreign currencies without the need for accounts with corresponding banks. As all participating banks could potentially hold the different CBDCs directly, they would be able to transact directly with each other in the participating currencies. End quote. Concomitant with the benefits of adopting CBDCs, there are risks for the international monetary system, and these need to be assessed very carefully. There are both known and unknown issues. A CBDC that can be used outside its own home country might increase the risk of currency substitution. According to Fabio Panetta of the European Central Bank, in a paper titled Hic sunt leones, Open Research Questions on the International Dimension of Central Bank Digital Currencies, and I quote, trade and finance leakages with the issuers of international reserve currencies, the United States, the Euro area, and China, vary considerably across currencies. That in turn suggests that the risks of currency substitution vary significantly across countries and currencies. End quote. For more on these linkages, see the chart, which is courtesy of Panetta. Panetta further says, and I quote, a CBDC can magnify the cross-border transmission of shocks, increase exchange rate volatility, and alter capital flow dynamics. To realize the full potential of CBDCs for more efficient cross-border payments, international collaboration will be paramount. Cooperation on CBDC designs will also open up new ways for central banks to counter foreign currency substitution and strengthen monetary sovereignty. End quote. CBDCs could substantially streamline the cross-border payment chain. See Figure 5, which is courtesy of our and others. Lastly, where do the various central banks stand on CBDCs? Based on my assessment, I will divide the world's central banks into 2 categories. Refer to the chart, which is courtesy of the Federal Reserve Bank of New York's Liberty Street Economics Series. 1. The innovators. As I see it, the innovators are those central banks that have taken the lead not just in the debate, but the implementation of digital currencies. Among these are 1. The People's Bank of China, which has initiated a pilot, the eCNY, which is the digital version of the renminbi. 2. Bank for International Settlements, which has conducted proof of concept trials. 3. The Bahamas, which has introduced the cent dollar. 4. The Central Bank of Nigeria, which has introduced the e-naira. 5. El Salvador, which chose to adopt Bitcoin as its digital currency instead of developing its own. 6. The European Central Bank, which has an ongoing exercise but has made it clear that it regards the development of a CBDC as a priority. 7. The Bank of England, which has adopted a stance similar to the ECB, except it has indicated that it will not rush into the creation of a CBDC, but will follow a slow, methodical process that will not be prejudged. 8. Bank of Canada. 9. Bank of Jamaica. 10. Reserve Bank of Australia. Bank Negara Malaysia, the Central Bank of Malaysia. Monetary Authority of Singapore, and the South African Reserve Bank. These are central banks that are part of Project Dunbar. 2. The skeptics. The skeptics are so named because these are the central banks that have questioned the rationale for creating CBDCs. These are 1. The US Federal Reserve. Even though the Fed is continually conducting research into CBDCs and churning out interesting and useful articles and papers, it has unequivocally indicated that it sees no need for a CBDC. 2. The Bank of Korea, which has also indicated that it sees no need for a digital currency, but has decided to set up a task force to investigate a CBDC on the off chance it may have to create one, not least because of the seeming widespread interest among world central banks. 3. Although the Bank of Canada has been at the forefront of CBDC developments, it has for the time being expressed a skeptical view like that held by the Fed. 4. The IMF, which has presented data supporting its view that most central banks' mandates and laws do not allow them to issue CBDCs, and less so, retail CBDCs.